What if I told you there's a tiny number, we're talking less than 1%, that could be costing you thousands of dollars over your investing lifetime? And the crazy part is you'll probably never even see it on a statement. Well, today we're going to pull back the curtain on this hidden cost, the ETF expense ratio. And more importantly, we're going to show you how to stop it from slowly draining your growth. Okay, I want you to picture your investment portfolio like a bucket. You're trying to fill it up, right? You put your hard-earned money in, and you just expect it to grow over time, helping you build that financial future you're aiming for. But what if that bucket has a tiny, almost invisible leak? Just a slow, steady drip that's siphoning off your money year after year. You never get a bill for it, you never get a notification, it's just happening in the background. Well, today, we're going to find that leak and we're going to plug it for good. So what exactly is this silent leak we're talking about? Well, it has a name. It's called the expense ratio. To put it simply, an expense ratio is just the yearly fee that an ETF charges to cover its operating costs, to keep the lights on. It pays for stuff like the fund manager's salary and all the boring administrative work. Just think of it as the fund's annual management fee, and it's always shown as a percentage. And here's the thing that makes it so sneaky. You never actually see the charge. It's not like you get a bill in the mail. The fee is just automatically taken right out of the fund's assets. It's this invisible little transaction that just quietly reduces your overall return. That's what makes it such a silent and, frankly, dangerous leak. So let's put a real number on this. You're looking at different ETFs and you see a figure like this one, 0.10%. Now you look at that and you're probably thinking, so what? That's basically nothing. What's the big deal? And you're not wrong, it seems like nothing. In the real world, a 0.10% ratio means for every $1,000 you have invested, you're paying them $1 per year, just a single dollar. It's so easy to just dismiss that, right? But stick with me, because that one little dollar has a much, much bigger impact than you'd ever guess. So what's a typical fee then? What should you actually expect to see out there? Let's take a look. The general rule is pretty simple. The simpler the fund, the lower the cost. Your broad market index ETFs, the ones that just track the S&P 500 or the total stock market, those are dirt cheap. But as soon as you start getting into more specialized funds, like ones that focus on a specific sector like tech or healthcare, or ones that are actively managed by a team trying to beat the market, well, those costs start to climb a lot, sometimes even over 1%. And that, right there, is the absolute key to all of this. A few tenths of a percent, it just doesn't sound like a big deal day to day. But over decades, the magic of compounding can turn those tiny, tiny differences into a huge gap in your returns. And I'm going to show you exactly what I mean. Okay, this is the main event. Let's actually run the numbers and see what the real-world cost of a seemingly small fee difference looks like over 20 years. Okay, so imagine you invest $10,000. You're trying to pick between two funds that are almost identical. You've got ETF A with a really low fee of 0.10%, and then you have ETF B, which is a little higher at 0.50%, which, by the way, is still a very common fee out there. Now let's hit the fast forward button. 20 years go by, let's just assume an average annual return of 7%. That initial $10,000 in the low fee ETF, it would have grown to almost $39,000. Pretty good. But in the higher fee fund, it's only worth about $37,000. That's a $2,000 difference. $2,000, just gone. Not because of a market crash, not because of a bad investment choice, but simply because of that tiny 0.40% difference in fees. That is the power of the silent leak. It really adds up. Okay, but here's the good news. This is one of the very few things in investing that you have almost complete control over. So let's talk about how you can plug this leak starting right now. It's honestly a really simple 3-step process. First, just get in the habit of always checking the expense ratio before you even think about investing. Second, compare it. Look at other similar funds and see what they're charging. And third, if everything else looks pretty much the same between two funds, just pick the one with the lower fee. It's seriously one of the easiest wins you can get in investing. So let's just boil this all down. Low costs are basically a superpower for you as an investor. Every single dollar you don't pay in fees is another dollar that stays in your account working for you 24/7. And over the long run, that is what unleashes the full incredible power of compounding. It can make a massive difference in where you end up. So we'll leave you with this to think about. Now that you know how to spot and stop this silent leak, what other small, hidden costs in your financial life might be having a bigger impact than you realize? It really pays to be curious. Thanks for tuning in.